to be another video in the chapter Money and Banking. You can check out my YouTube channel where in the first video I explained about the importance of money. In the second video I explained about the banking basics. In the third video I explained about money multiplier, and in this video we are going to study how a central bank functions in the economy and how it is very, very important. So this is part 4 of the chapter Money and Banking, Central Bank. So what is a central bank? Basically, a central bank is established in an economy to control credit creation and for the regulation of currency in a country. So in order to create credit and in order to regulate the flow of currency in an economy, there is an institution called as the central bank. And in India, it is called as the Reserve Bank of India. The Reserve Bank of India was established on 1st April 1935. And it was based on a special parliamentary act called as the Reserve Bank of India Act of 1934. Currently, Shaktikanta Das is the governor of the Reserve Bank of India, and the headquarters of the RBI is in Mumbai, Maharashtra. As of December 2021, currently the RBI has rupees 4,669,426 crores as its reserves. Moving further, here are the functions of a central bank. There are basically 6 functions. We will try to understand them one by one. The first one is that a central bank is called as a bank of issue because it is the authority which issues and helps in the flow of currency notes. All currency notes are printed by the Reserve Bank of India and they are circulated by the Reserve Bank of India. With regard to coins, coins are minted or prepared by the government of India, but then it is the responsibility of the Reserve Bank of India to ensure its circulation. And so you can check out about legal tender in the previous video where I explained that the authority to allow a currency to be accepted by all is called as legal tender, and this authority is given by the Reserve Bank of India and in collaboration with the central government. And so this is why it is called as a bank of issue, because it issues currency notes, it helps in the circulation of coins, and this is the authority which gives legal tender. The second function is it is called as the bank of the government. It is the main bank which provides loan and financial support for central and state governments. All central and state governments have their deposits directly in the Reserve Bank of India. It provides loans and it also advises the governments for their investments, especially for developmental projects. The funds are flown from the governments through the RBI, and all these funds which are for development are non-political. Any kind of political agenda, any kind of political activity is not funded by the Reserve Bank of India. It is purely for the development of the nation. It is also called as a banker to banks. This is because all banks keep their reserves in the form of cash reserve ratio with the Reserve Bank of India. If you want to learn more about CRR, you can check out my previous videos where I explained about the cash reserve ratio. All loans for commercial banks are provided by the Reserve Bank of India, and this is the authority which monitors all commercial banking activities. I have already explained this in the second video of my chapter of how the Reserve Bank uses various ratios to control the flow of money through commercial banks to the economy. It is also called as a lender of last resort. This is because whenever an economy is on the verge of collapse, it is the Reserve Bank or the central bank of an economy which provides or releases all its reserves so that in cases of emergency, still there will be a flow of money in the economy. And so this is the lender of last resort which provides loans even in the dire emergency situations such as economic collapse or economic crash. It is also the custodian of foreign exchange because it safeguards and monitors the flow of foreign currency in and out of the economy as well as gold reserves of the entire economy. And finally, it has other functions such as discounting bills between the government, between various banks, and also is focused towards industrial development. So these are the 6 functions of any central bank in any economy. Moving further, This is one of the most important functions, that is credit control. This is the seventh function, and this will be studied in detail in this chapter. Credit control is very, very important because this will make us understand how actually the economy works. The RBI controls the credit and flow of money within an economy. The RBI controls inflation and deflation within an economy. And how does it do it? We have already studied this in the money multiplier process, but then once again we will try to apply that money multiplier process here in this particular function of the central bank. Imagine in an economy there is more flow of money. This means whenever more flow of money is there, more people will have money and people will start to purchase more things. When people start to purchase more and more, this will be called as increase in demand. And naturally, when the sellers are seeing that the demand of their products is increasing, they will increase the prices so that they will have more profit. This situation where there is sudden increase in price is called as inflation. During this time, RBI will try to remove the excess of money from the economy so that there will be less flow of money, so that there will be less purchases, so that there will be less demand, and so that the prices will not increase. This is how the RBI steps in to control inflation. Imagine the opposite of this situation. Imagine there is lesser flow of money, and because of that people do not have money, they do not purchase, or the purchases are very, very less. This will cause a decrease in demand, and the sellers, in order to entice the people, will decrease their prices so that the people are more and more attracted to purchase. This decrease in price is called as deflation. And during this situation, the Reserve Bank of India will try to inject or put in more money into the economy so that the flow of money will increase, so that purchases will increase, so that the demand will increase, and subsequently the prices will also increase. So this is how RBI controls the credit within the economy. So how does it actually do? We are going to study this soon. There are two basic measures used by the Reserve Bank of India, and the first kind of measures are called as quantitative credit control measures. When I speak about quantitative, it means, or it derives its meaning from the word quantity, which means this is directly the measures used by the RBI to increase or decrease the quantity of the flow of money in the economy, and that is why these measures, which I'm going to explain, are called as quantitative credit control measures. The first one is open market operations. What do we mean by that? During inflation, which is a situation of price rise, the RBI sells government bonds, shares, and securities, which are basically paper pieces which have a particular value of money, and these are sold in exchange for currency notes, which means the people will get the title of the bonds, the ownership of shares, and the ownership of securities, and for that people will have to pay money in the form of currency notes to the RBI. And so this is how excessive money from the people or from the economy is removed by the RBI. During deflation, or that is less prices, that means the people have very less money, the RBI buys back the government bonds, government shares, and securities in exchange for new currency notes. So when the RBI buys from the people, it gets the ownership of the bonds, shares, and securities, and in exchange for that, RBI releases new currency notes into the economy. And since this new money is injected in the economy, it will increase the purchasing power of the people, and with that demand and prices slowly increase. So these two operations are called as open market operations, where RBI directly buys and sells government bonds, shares, and securities in the open market in order to increase or decrease the flow of money in the economy. The next one is bank rate policy. For that, you have to first revise the second video where I explained various ratios. Now, RBI provides loans to commercial banks, and the interest on these loans, which the commercial banks will have to pay back to the RBI, is called as bank rate. Now, if the bank rate is very, very high, commercial banks will not be encouraged to take more loans. They will take lesser and lesser loans because it is too high to pay this bank rate interest to the RBI. In return, lesser money will be out for the public in the form of loans, and so less money will be circulated in the market. On the opposite, if bank rate is low, then the commercial banks will take more loans because they have to pay less interest to RBI, and that loans will be once again given to the public and more money will circulate in the market. When the RBI takes loans from commercial banks, it pays an interest which is called as reverse repo rate. Now, when the reverse repo rate is high, commercial banks will love to give more and more loans to the RBI because they are getting more and more interest from the RBI. And because of that, lesser money will be available for the public in the form of loans because all the loans are now directed to the RBI. And because of that, it will reduce the flow of money in the economy. If the reverse repo rate is low, which means if the RBI is paying lesser interest while taking loans from commercial banks, then the commercial banks will not be ready to give loans to the RBI, and instead they will be ready to give more loans to the public. This will increase the flow of money in the economy, and this is how the RBI uses bank rate policies such as bank rate and reverse repo rate to increase and decrease the flow of money in the economy. The next is varying reserve requirements. This is once again a revision of what we have studied, that is cash reserve ratio and statutory liquidity ratio. So these two ratios are controlled by the RBI. The RBI can control cash reserve ratio and the statutory liquidity ratio. Once again, to revise, cash reserve ratio is that part of the deposits in a commercial bank which is supposed to be kept with the RBI as reserve. And statutory liquidity ratio is that part of the deposits which is compulsorily supposed to be kept in the form of ready liquid cash with the banks in their vault. So now, whenever CRR and SLR are increased, commercial banks are forced to keep more reserves and they will have very less money to give out as loans. This will decrease the flow of money in the economy. Whereas when CRR and SLR are decreased, it means the commercial banks will have more money to give out as loans to the public and the flow of money in the economy will be increased. So this is how varying reserve requirements are used by the RBI to increase and decrease the flow of money in the economy. So these three were the quantitative credit control measures, that is open market operations, bank rate, and varying reserve requirements. We will now move into the qualitative credit control measures used by the RBI. These measures are taken up by the RBI indirectly to encourage and discourage commercial banks while giving out loans. So these are not a direct involvement of the RBI. These are indirectly appealing to the quality of encouraging and discouraging commercial banks, and that is why these measures, these three measures which I am going to explain, are called as qualitative credit control measures. The first one is called as marginal requirements. Whenever loans are given out by commercial banks to normal people like you and me, they require a collateral or a security of some value. For example, while taking a personal loan from some banks, they demand a personal asset as security. So imagine if your personal asset has a value of rupees 50,000, they will give you a loan of only rupees 45,000, keeping the 5,000 rupees value as a margin. So this is called as margin. The 5,000 which is not given to you, only 45,000 is given as loan. That value is called as margin. So the RBI can appeal or direct the banks to increase the margin of securities, which means now if the margin is increased, people like you and me will not spend the loan unnecessarily, because if we spend it unnecessarily, then probably we will lose more than what we got as a loan. And so because of that, some people might also be discouraged to take a loan, and this is how money is flowing less in the economy, because people are now afraid to take loans because the margin is too high. Moving forward to the next, it is called as moral suasion. The RBI uses seminars, letters, speeches, and discussions with commercial banks to encourage or discourage giving out loans to the public according to the situation. Which means if the situation is very tough and there is very less money flowing into the economy, the RBI will use seminars, letters, speeches, and discussions to encourage commercial banks to give out more and more loans. Whereas if more money is available with the public, the RBI will still use the same techniques in order to discourage the commercial banks from giving out loans. And the final qualitative credit control measure is selective credit control. RBI can also direct the flow of loans into certain sectors. For example, if the RBI feels that the agricultural sector in an economy is suffering and the service sector is booming, the RBI can promote more loans to agricultural sector and can instruct the banks to give out less loans to the service sector. With this money, it will be supplied to the sectors which need more development. So in this case, if agricultural sector needs more development, the money which is supposed to go to the industrial and service sector will now be directed towards the agricultural sector. So this is how RBI channelizes the flow of loans into the sectors which need more development. These were the three qualitative credit control measures: marginal requirements, the second one was moral suasion, and the third one was selective credit control. With that, we come to the end of this video. Thank you so much for staying tuned till now. You can check out my channel where in the first video I explained about the importance of money. In the second video I explained about the basics of banking. In the third video I have explained about money multiplier, and in this video I have explained about the functions and the workings of central bank. Thank you so much for staying tuned till now. If you found this video helpful, please like, share and subscribe so that many more students can benefit from it. Thank you so much. Stay educated and stay safe.